Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content. It is Monday, May 9th, 6:21 a.m. as I'm starting the video. And as always, please run your player at 1.5x for maximum efficiency. I hope everyone out there had a nice Mother's Day yesterday, whether that be a dinner together, a nice phone call to catch up, or a nice memory if your mom is no longer with us. I had a nice dinner with my parents. It was great. Had a good time. So let's dive into the week. We're already well into the red. Quick look at futures. Bitcoin down 7%. Oil down 1.75%. Stocks between 1.5% and 2% down. Gold down 1%. Copper down almost 3%. Nat gas up about 2%. Not much on the macro front. We've got that Russian victory day. Who knows what that might mean for today. People talking about Ukrainian escalation, whatever. Very hard to read. This week, you're going to see a parade of FOMC speakers, as we talked about last week. Probably putting exclamation points on what Jay Powell was talking about. And really, the biggest data point this week is inflation numbers on Wednesday morning. So that's going to be a really big number. Not going to get into the earnings for today. You can go to the blog site. I've got the calendar. Excuse me. Got the calendar there for you. I will say this. Those companies that have been lucky enough to beat earnings and they get that earnings pop, all those pops are being faded. So, like, for instance, Palantir is this morning. And just as a side note on that one, it has already done a round trip from its, IPO, and then all the hype, and now it's right back to where its IPO was, I think, at $9 or $10. But if you see a big pop, I think you can almost count on that being faded. And also, if you see a miss, it was reported over the weekend that those companies that are missing earnings are getting punished more severely than in the past. So you see somebody miss and you say, oh man, it's off, and I saw it last week, a couple of names, off 15, 18, 20%. You say, oh wow, man. But then you don't do anything, and then at the end of the day, they're off, 28%. They just keep going. So if you see some of that stuff and you're, at your desk and you want to, participate in those types of trades, I think there's probably some opportunity there to fade pops and get on the bandwagon of these ones lower that miss earnings, but I'll leave that up to you. And also on the website this morning, on the blog post, I give you a list of about, a dozen tickers from Friday that have set up for bracket trades during this earnings, bonanza when they're coming hot and heavy. And then you can track as few or as many as you like on those bracket trades. And remember, just like I said, most of them are heading lower, and you see a gap down. The default position is it's going lower. Set your alarm. When you get it, then you can get short, etc. So let's get into our charts for this morning. We had some downside follow through from Thursday's big drop, and then Friday we had a little downside follow through, but not a lot. On Friday, if there isn't bad selling, they like to park it at a place where, my God, should I position for a bounce or should I position for Downside, they want to keep you biting your fingernails all weekend. Maximum risk kind of thing. So obviously today we are down, so we're going to have that gap above, and we'll just see if they, go up and try to fill that somehow, or just keep heading south today. But as far as the oscillators go, we're here on the NASDAQ oscillator at minus 35. No, not a place to look for a bounce as far as this goes. We'll have to see today, what happens, but easily can come down to minus 60, minus 90 kind of thing. And don't forget, if things get real ugly, we have seen numbers into the hundreds. That's not something to count on, but just reminding you that that's possible. If we jump over to the New York Oscillator, same thing, minus 35, same setup, and just remind yourself of these kind of trading cues. If you're massively short right now, when we get down, if there's a big down day today, you can start, trimming out of those. Certainly not a place where you'd want to go like max short kind of thing. If we're down a lot today, it's when you want to start getting out and positioning for, an eventual bounce. Our VIX, this morning we're up at 33 already, so we're up, 10%, 3 points from where we closed on Friday. This has been a great thing to watch during the day. I've been keeping it front and center on my board, devoting, one little section of my trade montage just to keep that front and center. I find it easier than trying to look over on a side panel of what's going on. Just keep it up like it's a chart you're trading, and then you see it right there, and you can see support and resistance, how it behaves around those levels, etc. Bitcoin, I think, is in real trouble, along with all the cryptocurrencies, Ether and all these other junior coins, down 7% today. It's a liquidity and momentum thing. As liquidity comes out, you're going to see these things go down. And I'm just talking technicals. So if you're some kind of, Bitcoin Super Bowl, my advice would be, unless you bought it at, 3,000 or something, you're just in it for the long haul, that's fine. But, eject your position. And then if it goes down to 15,000 or 8,000 or wherever it settles, then you can get long again. But I don't see any point, at these levels having support having broken and down 7% today. Why you would want to just hold that thing, write it down when it seems almost inevitable. I wouldn't be listening to Michael Saylor or Kathy Wood or Jack Dorsey or any of these other guys that have a horse in the race. You got to manage your own position, and the technicals say lower. So let's move on to SPY. We had more or less a doji day on Friday. This has been a real battleground at 410, where the February low was. We're already below the March lows. And so now this morning we are down around 405, which were the spike lows of the other day. This is the this wasn't the Fed day. A couple days before that, we went down and looked at 405 and bounced. And then Friday, we went down I don't think we quite got the 405, but we got close. But now we're back at that level. And, should 405 break, this morning, I think you're going to come down to this. Got a little gap in the charts. I think you're looking at 400, 395 kind of thing. We got some support at 390. If we go down to the 2-hour chart, the reason I jump back to 2 hours is one thing that's kind of goofy about stock charts is that, it'll run down to the end of the page and not reset till the new day opens. So just to show you where we're at, right here at this 405, there's a support level. And if that breaks, I think we're going to be coming down for a test of 400. And then that will be a big psychological level, because once then you get below 400, then you got to look much lower, down into 390, 380 type areas. Moving on to the Qs, Friday, we did make a new low, and taking we're pretty much well below the February and March lows at this 317.35. And if you're looking for like a big level, that's your big level from the standpoint of if the bulls were able to bounce this up above 317.35 and certainly above 322, I think you got to be just covering your shorts and stuff depending on when you got in. But notice this first, that thing we always say, first touch of the gap usually holds, and it held on Friday. But I think now the technical objective is to fill that gap down to 300. And then we've got a measured move target down at 290 from this bear flag type structure. So those are a couple levels for you: 305, 300, and then 290. So I'm looking for further downside there. Here's a little zoom in on that with the gap actually goes from 305 to 298. I don't even have that drawn in correctly here. I have it at 300, but it's really 298. So then that would be a place where you'd probably, unless things start really feeding on themselves, if it just kind of works its way down there, I'd expect 298 to initially hold, and then we can recalibrate around that level for the next leg down if we do in fact see that. IWM, what a head fake. We had the short-lived bear trap. This was the little 3-day Fed bounce back, little fake breakdown, ramp back up, and then whoever bought that on Fed day was immediately underwater. And now we have broken back below this trading range and actually made a new low. So the door is open for much lower prices. Let's see if I can find a weekly chart just to show you. Here's the weekly. Yeah, see, now we're down below. We had that reach up candle on the weekly after the Fed day, and then they faded that. So on the weekly chart, the door is open for a move down to this 50% retracement down at 167.50-ish for the measured move lower down into this area. And I think this is an important thing to note, and I think I've made this point before. That brings you back to the pre-COVID high. You can see it right here in February of 20. I think that's a place. It doesn't matter what chart you're looking at. That's a good reference point as a potential destination for whatever chart that you're looking at. So keep that in mind. Here it is on the 2-hour chart. Not a lot of detail to add. Just a series of lower highs and lower lows. But I think the most important thing is that we're below that big trading range with a new low on Friday. So I would anticipate more sellers coming in. Facebook has held up pretty well, but I think they're coming after them all right now. So any break below this 203 area is going to open up a run towards the top of this gap at 192. You'll have to decide, how you want to play it, whether you want to just wait for the gap or do something, sooner than that. But I think at a minimum, we're going to come back down and test the top of this gap at 192. Apple, I think, has to be on the top of your list as far as important stocks to watch, even if you're not actively trading it. We're sitting right here at 156.5. Our prior low was 153.5. You break the prior low, whether it be today or whenever, then you're going to open up the door for more selling. And as we've been pointing out here on the daily chart, we're sitting right at the 200 EMA. We're sitting right at technical support, actually maybe a little bit below it, and just below trendline support. So should that triple layer of support clearly fail and we break this prior low back in March, which was at, let's just call it 151, then you got the ball really going downhill. And that's something that's really going to impact the QQQ and SPY just because of the weighting of Apple, the highest weighted market cap stock on both of those indexes. So really heretofore, the market narrative per se, well, the market's only down, 13% or whatever it is. A lot of that is because, Apple hasn't cracked yet. Microsoft really hasn't cracked yet. So Tesla hasn't cracked yet. So those are really the final three. I think if you look at the other ones, they've already broken. So if Apple is the final one to go, as it should be, as the the 5-star general, if there is such a thing, the highest ranking stock in the index, if that one goes, then you're going to see the broad market averages catch down to the average stock, which is already well off their highs. Tesla holding up really well. You've got a beautiful pivot here at 860. You can see, support, brief undercut, which was quickly regained. So anything below 860 and certainly below 840, this prior low, you're going to see further downside. And you can see that here on the daily chart, coming off of those recent highs, lower highs and lower lows. And we've got a level down here at 825, which was the prior touch low, in the back half of April, and then you've got the March and February lows back here at 750 and 700. And so Apple is your big cap weighted leader, but I think Tesla is your retail sentiment type leader. All the other EV names and meme stocks have been hit. Tesla is the last man standing as far as, retail heavy traders and investors are still have the faith that it hasn't broken yet. So that would be one to watch as far as retail sentiment goes, in my opinion. Microsoft working on filling this gap down to 270. I think we're right at it, or maybe a little bit above or below here in the pre-market. I think if 270 breaks, then the door is open for a run to 260, and that comes off of the weekly chart. We can look at it here. Let's look at the daily. 260 I've got marked there. Here's the weekly chart. Actually, the 38% fib on the weekly is 263, and then the 50% fib is 238.50. So it's really interesting to note. We often reference the 40-week moving average here in green. Notice that for the last 3 weeks, we've had reach up candles to the 40-week average that have turned price away on each occasion. So when you're looking at your candles, when you see the wicks, when you see large wicks on a candle, that means, selling pressure, right? That it went up and then sellers came in and pushed the body of the candle down. So when you see these reach up candles to an important technical level, whether that be, technical resistance or a moving average or something like that, that just tells you there's responsive sellers in that area. And you'll see on the flip side, when you see sellers try to take a stock down, and you see the tails of a candle reach down and then touch a level and then come back up, it just tells you responsive buyers are at a particular level. So looking at the direction, whether the wicks or the tails, here's a couple of examples where the sellers tried to step in, and you can see the tails are long and there were no wicks on the top. So on those particular days, they tried to sell it down. The buyer stepped in and then closed it back on the highs. So just something when you're looking at your candles. I just got Amazon here on the weekly. We're going to open below 2,300. I think this is coming down to 2050, 2,000 to fill this gap, and then lo and behold, back at the pre-COVID type levels. So I think these are coming down. Already blown through all the Fibonacci retracements. And when you see that, when you go past that 618 retracement, what you're looking for then is that 100% retracement, a full round trip from where the thing started which was right here on this breakout from 2050. So that would be a place to identify on the charts. And then that will be a big place where I'd certainly expect a bounce. But if price were to fail at the top of this box, then your target becomes the opposite side of the box. As distressing as that might be, you'd be looking at something down around 1750, or possibly even that COVID low of 1650. So I think it's important at this juncture to have a completely open mind and not be saying, well, you know, it could never go here or it could never go there. Stocks go a lot higher than you think they can go, and they can also go a lot lower. So trust in your levels and, you know, trade accordingly. Google at a nice level here at 23.15, but honestly it's probably already down here at 22.50 at the bottom of this box. Had the Fed day fake breakout. They came right back inside this prior trading range, and now will find its way to the bottom of the box here at 22.50. I think it's going lower. Let's look at the daily chart. Probably coming down to 2200 just for starters. And if we go out to the weekly, we're here at the 38% retracement level already. And if you if price were to break 2200, then your 50% retracement is 27, and then your 618 is 1800, and then that is your next target. If that were to break, then you're back at the pre-COVID highs around 1500. So those are some rough downside targets if that were to break. Netflix, I don't know where it's at pre-market, but you break 177, it will open up more selling. If we look at the monthly, we've been talking about a target down at 125 for starters. And then your long-term trend line is back at roughly 65, something like that. So a lot more downside available to Netflix if they want to take it there. On semis, the big line I'm looking at is 223. Why? You've got a big ledge of support here at 223 on the weekly. You break that, then you are moving into a huge void on the charts with the 50% retracement down at 206, and then the 618 retracement down at, let's just call it 180. And then if you want that doomsday scenario, if you will, a full retracement back to the pre-COVID highs down at 150. So let's take a spin through ARC-land. ARC-F made a new low. I think it's going lower. ARC-G, same thing, new low. I think it's going lower. ARC-K, new low. I think it's going lower. ARC-W made a new low. And remember, Friday was not like a big down day at the index level. All the ARC names were on Thursday down about 10%, and on Friday down around 4%. So there doesn't seem to be any reprieve And it's all the things that we've been talking about. Bubbles, Ponzi's, frauds, all those stocks are getting exposed. And, Robinhood, DocuSign, Zoom, Snowflake. There's dozens and dozens of these names with PEs that are still in the thousands or worse, money-losing companies. They're just not going to work. And don't think that they can't take these ARK funds if in fact a bear market is coming or has already started, and or a recession is coming or already started. They can take these names down to single digits, ARK included, and they just won't stop. There's, what's the real reason to buy? Because one thing I would be doing is looking at their IPO levels. If they got in early, if it was an early IPO and it opened at a certain price, if that IPO level is broken, that means everybody that's still in is a loser. And so the pain threshold will feed on itself when more and more people throw in the towel, and that's when you get that real cascade type of a deal. So there won't be that's a real important level. Now the other ones that IPO'd much later, obviously their IPO is already, the price is already below the IPO there. So I wanted to focus on a couple of stocks. I don't have them all marked up and everything. This is Upstart. We had congratulated ourselves, somewhere back here. We got played for a gap fill, and that worked out, and didn't, there had been a subsequent rally, and now they're fading this thing again. Let's just discuss what Upstart is. It's that buy now, pay later format. And the thing to understand, forget all the stuff about fintech and all that kind of stuff. It's a technology company. It's a disruptor. All those buzzwords. These are lending companies. They lend money to people that want to buy on credit. And the people, for the most part, that use these services are the lowest tier of the credit, the credit stack. People with low credit ratings tend to gravitate to these types of services. And when these companies started, the defaults, because of all the stimulus and all that kind of stuff, the free money, the default rates were really small. Well, those default rates are growing, and if the economy slows down, these default rates for on the loans that these guys are lending are gonna mushroom. So somebody gets buys an item on through one of these services, and they get that item, they make one payment or zero payments or however it works, and then they just don't pay anymore. And so they've got the item and they just don't pay. And then that's a default. And what these companies do is they package up their monthly loans and then try to sell their loan packages to other investors, and they're not going to get as much for them. So in the case of Upstart, they're gonna have a harder and harder time. Affirmed is another one, negative PE, breaking and making a new low here. These companies can go to single digits, is what I'm saying, especially if there's any kind of the economy is still relatively good, but if we, slip into a recession, these companies are going to be, on the outside looking in. Either their transaction volume will either do a moonshot, but with a super high default rate, or their loan volume will crater, because the consumer will pull back. But in either case, it's not a good scenario for their particular business model. Look at Lending Tree, just traditional mortgage finance. Nobody's refining mortgages. They're all laying off. Rocket Mortgages. Those companies are all headed much, much lower as mortgage rates skyrocket and refis go to zero. So some things to look at. Be careful out there. If you are a person that is not comfortable shorting, more of a, we talked about in your IRAs, we are below the 20-month monthly moving averages. Just go to cash, sidestep what could be a really, really nasty type pullback, and then once it looks like we've bottomed, then you can start stepping in. But if if you are actively trading, you should be looking at further downside, in my opinion. And just remember, and you may be one of these people that are relatively new to the market, like the Robinhood crowd, type people. They've never been through a really, really rough market environment where the Fed is not there to backstop everything. So, like for instance, the ARK funds saw some of their biggest inflows last week. Why would retail be going long into ARK at this juncture, as it makes new lows in this environment of, somebody said she's got 35 holdings in ARK and only one is positive, and that's money market at 3 basis points. Every other security is significantly red for the year. And so if you're a retail investor, why would you be, are you trying to pick the bottom here? Way too early for that. So be really careful on the long side. The market is definitely in a downtrend, and I don't even think everybody has totally picked up on that. I think they're still trying to pick bottoms. And yes, there's going to be rips. When those oscillators go minus 60, minus 90, we're going to be looking to cover our shorts and either wait for a bounce to fade, or if you're nimble, try to catch that rip. But I think we got significant ways to go on the downside before this cycle abates. So be careful out there. If you're new to the channel, you can tell it's all technically driven. I give you objective levels to trade around. If you like that kind of analysis, please hit the subscribe button, the alarm bell. Leave me a comment below of what you'd like me to look at. I'd be happy to work in a sector or a specific stock in one of the upcoming broadcast, happy to do that. Jump over in the show notes. You'll find a link where you can add your email to our roster, join the team. You'll get an invite to our trading room. You'll get a lot of ideas there. We'd be glad to have you on the team. And longtime listeners, thank you so much for sticking with me. I appreciate it. Hope you're benefiting from the work. And we'll see how today goes. This has been Chris Buss with Traders Profit Compass. Talk to you next time.